Hey, Sats fans. Welcome back to Swan Signal Live. These are my favorite episodes of this podcast by far. Our quarterly reports with Preston Pysh and Andy Edstrom. We've been doing these for 2 years now. We check in at the end of every quarter, look back on things that happened, and make some predictions about what's to come. And we're going to do the same this year. We're going to get to the show in just a moment. A quick announcement. This is my last Swan Signal Live episode. This is my last podcast probably, and I've been doing this for about 5 years now. Started with Citizen Bitcoin in 2018, and went basically through that whole year with like no listeners at all. But picked up steam in 2019 when I started interviewing some big name Bitcoiners. I finally had grown the confidence to reach out to some of the big names in the space and asked them to come onto my podcast. Previously, I'd just been hanging out with a friend of mine and talking about Bitcoin, which was also great. And when that started in 2019, things kind of took off. And so did my sort of, I guess, what began my Bitcoin career at Bitcoin 2019 in San Francisco. And met a bunch of the people I'd been interviewing and made tons of connections, including with Corey Clipston, who was at the conference talking about Give Bitcoin, his project to help gift Bitcoin and Bitcoin education to people in an easy way. And later that year, started working with Corey and Jan and team to build Give Bitcoin, which pretty quickly turned into Swan, as we found that Bitcoiners were creating Give Bitcoin accounts to give Bitcoin to themselves using our recurring gift feature. And so what we saw is that the plebs wanted an easy Bitcoin-only DCA platform, and then Swan was born in March 2020. And right at the same time, we put the product out at the end of March, right when the COVID crash hit. We also started Swan Signal Live. The first episode of this podcast happened in, I think it was like March 29th, the day after the big crash. And we were down and, hit 3,000s and there was a bit of panic on Bitcoin Twitter. So we decided to go live with a great group of Bitcoiners, about 6 of us, and just talk about what was happening and hopefully give some newer Bitcoiners a little bit of confidence that, this is part of the ride, the roller coaster ride that is Bitcoin, and things are going to be okay. Now is a great time to stack some cheap sats, and let's just push forward and rely on that conviction. And that just kind of off the cuff show just turned into this podcast. It was kind of a novel in the space to invite 2 Bitcoiners on at the same time and just go to kind of a rotating stable of guests, the best and biggest names in the space. There's maybe been 30 different Bitcoiners on the show, and Press and Andy have been on double-digit times. And so that's the formula for this show. And I think it remains unique and a great format. And I'm really excited to be passing the baton for this show, for Swan Signal, over to my friend Sam Callahan, who I'll bring up here in just a minute. He did actually guest host this the Q3 quarterly report with Preston and Andy, and he's been working on the show with me for basically all year, helping me research and prep for the show. So he is ready to go and take on this new project in 2023. So let's bring in our guests, Preston and Andy, and I'll pop Sam in as well, who's behind the scenes. Hey, Sam.
Yo.
What's up, man?
Hello. Yeah, man. I'm super honored to take the reins, and very surreal for me because I listened to you before I worked at Swan, and I learned a lot from you, man. And helping you on the show over the last year has been a privilege. And I still get to work with you, so I'll still see you around and everything. But yeah, man, I have some big shoes to fill, but I'm super excited to take over the reins and maintain the quality here that you started. So very, very excited, man. So congratulations on everything. Seriously.
Thanks, brother. Yeah, I'm excited to watch what you're going to do and take this show to new heights. Sam is far more qualified than me to host these macro shows, especially as you guys probably know from some of his work. And so I'm really excited for Sam to have this platform to bring some more visibility to his great work. So Sam's star will certainly continue to rise in 2023. All right. Thanks, buddy. Let's get into the show. Andy Edstrom, you're looking fly, man. You're looking healthy. This is a really nice kind of blue Bitcoiny shirt you got going on. How are you doing tonight?
Oh man, never better, Brady. I'm loving this bear market. I'm loving being with you guys. I'm loving my new bright orange shirt, which was a Christmas gift. And yeah, just happy to be here. We got a lot to talk about. I'm sorry we found a smarter and better looking version of you to replace you, but you'll be you'll be forever missed. And I know that Citizen Bitcoin will ride again. We'll see what you do next.
Yeah, well, I doubt I'm going to come out of retirement, but sometimes it happens. It seems to happen all the time. Maybe I'll miss it. Maybe I'll reboot Citizen Bitcoin, but I doubt it. Preston, how you doing tonight, man?
Doing great. I don't have anything else to say other than
I'm glad you're here. Glad to see you. Some prime time action here at the end of the year. It's been an absolutely insane year, as every year in Bitcoin is, but this one may be particularly insane. In my 5 years here, this has been just an incredible dominoes of events, starting from the beginning of the year, culminating with this FTX collapse, and so much going on in the macro level as well. So let's start with this. Andy, why don't you give me your maybe biggest kind of overriding story of the year in Bitcoin?
I guess I'll go with the obvious. Well, maybe I'll say two things. One is TikTok next block, to quote you, Brady. Bitcoin lives on. These edifices, these false structures that were riding the coattails of Bitcoin that were exposed this year. Thanks to the plebs, thanks to Corey, thanks to all those who helped expose them, have all gone the way of the dodo, or many of them have, and yet Bitcoin continues. So, that's the main story, which is that the story continues on despite the burning of these structures around it. And then the second, biggest story is obvious, but maybe I'll pass it to Preston in case he disagrees with me.
Well, what's the second biggest story?
I mean, for me, it's SBF. Yeah, there you go. It's Brady's retirement. It's Brady's swan song. Yeah. I mean, for me, it's FTX and SBF is the biggest story, but there are other candidates for sure.
Yeah, I think that that's an obvious choice for sure. Preston, do you have a lesser obvious choice that maybe at least will eventually have as big an impact as this year's contagion that led to FTX's collapse?
I would probably I think that's what it is. I think that we had unprecedented amounts of stimulus globally pumped into the system. So as they try to get that under control, looking back at it, it's very easy in hindsight to kind of make these types of comments. But we should have expected a significant contraction as they're trying to get some of this stuff under control. And then when you look at the cesspool that was stood up around the easy money that was just pumped into the global economy everywhere, you got to expect really bad actors and creatures to kind of emerge out of something like that. So did I see FTX blowing up in the way that it did? No. Did I find his interactions with certain political people and just the way he was doing business as being just not making sense? Yes. But I never thought that it was as negligent as it was, and as fraud based as it was between FTX and Alameda and everything else that was happening. But yeah, but in short, I would just say this year can be characterized as a dramatic contraction after a dramatic reflation and stimulus event that preceded it.
Andy, you were banging the drum about leverage in the system starting back in a year ago at that show. On the show, one of your predictions was that we're going to see systemic leverage built up in the crypto system, not only the crypto system but also the system more broadly, that could lead to some big disasters in 2022. Obviously, that came to pass. Do you feel like enough leverage has been wiped out at this point, or do you think there's more to come? Do you think that this kind of leverage trading is ever going to slow down? And last part of this is, do you see it as a long-term risk, this kind of leverage and this paper Bitcoin being printed? What do you think about the risk for Bitcoin that this practice continues moving forward?
Yeah. So thanks, Brady. Even I was surprised by the level of leverage in the system. It was shocking and appalling. What can you say? It's I guess part of it has to do with human nature. People can't help themselves. Hubris is a real thing. I guess part of it is playing with other people's money. You probably take more risk with other people's money. At least certain people do take more risk with other people's money. Obviously, the Fed was not helpful in limiting the leverage throughout the economy, including and especially in Bitcoin and the crypto space. And so, yeah, I mean, it was. I was surprised by even by the level of what occurred. I knew it was a problem, but I didn't know it was going to be this big of a problem. With respect to your question about, are we done? Basically, is the deleveraging done? I guess it's kind of the same question as like, have we bottomed in price? And the answer is, you never know until you look at it in retrospect. There are a couple candidates out there. Obviously, I mean, Tether's always out there. GBTC and Grayscale and DCG are out there. You got Silvergate Bank. I mean, there's still obviously Binance. There's all these entities that are risks. I'm not especially worried about any one of them in particular, but I definitely can't say that all these risks are behind us. So I'm sort of cautiously optimistic, but nothing would surprise me. And then just real quick on your last question, is paper Bitcoin a problem? Is leverage is false Bitcoin, not real Bitcoin that you thought you owned at FTX, but actually they didn't have any Bitcoin. Yeah, it's a problem. It's a problem. I think Preston's been talking about that issue for a while. Others for sure, Caitlin Long. I don't know when we'll get past it. Your guess is as good as mine.
Paper Bitcoin's an issue if you're too lazy to take physical custody,
right?
Because it couldn't be any easier, relatively speaking. Like when you look around, like, hey, if you own Apple stock and you want to take physical custody of those stock certificates so somebody's not rehypothecating them on an exchange, that's pretty hard to do. It's pretty hard to do. There's not like an easy solution where you can just like take Apple tokens and put them on your phone and like nobody can rehypothecate those certificates. So I just find our paper Bitcoin is going to continue to be something that people try to pull on unsophisticated retailers around the world. Of course, you're going to continue to see it. But where this is different is if you do a little bit of homework, and it doesn't require a whole lot of homework, it's pretty darn easy to take physical custody of your Bitcoin relative to everything else on the planet that can retain buying power like Bitcoin can. So that's the thing that makes this different. And that's why this is so important for people to wrap their head around taking physical custody, because if you understand it, you can sleep well at night. You really can. One
little piece of hope I have is that events like this can be used as, direct teaching tools to people to take custody of their Bitcoin. But also in the future, we can say, hey, do you remember this? Do you remember hearing about this where people lost billions and billions of dollars in 2022? Yeah, well, here's how you can avoid it, right? And I've actually seen a couple of crypto shows. Don't ask me why I was watching crypto shows, but I saw a couple and they were actually talking about self-custody. I was like, okay, well, that's good. Like preach that, right? During the bull markets, when everyone's frothing at the mouth, tell people, hey, take custody of your stuff. But they're probably just want to leave it on exchange anyway, because they're not going to hold it for very long. That does happen. That's going to continue to happen. I was very bullish to see massive historic outflows of Bitcoin from exchanges in the wake of this, though. We have a couple questions from the chat. I think this might be a good one to throw in there now. So how do we get the younger demographic, younger people, to adopt Bitcoin and educate them on how to avoid exchanges? I mean, watching these things happen and then using them as a tool would be my answer. But if either of you've got another idea here, that'd be great.
So pain's a great teacher.
Yeah.
And there's been a ton of pain in the last year. And just because you didn't experience the pain doesn't mean that the friend that you have who did experience the pain doesn't tell about their scar tissue to their friends. And so when I look at the FTX blow up, it's horrific for the people that had to go through it. But a little bit of the blessing there is that they are going to be talking to their friends on the next bull run. They're going to say, oh yeah, I had all these FTT tokens, I had whatever, and I got slaughtered.
Yeah.
I didn't understand this core thing. I know when I came into the space, the Mount Gox had just happened, and it was jammed down my throat as a person who was just starting to interact with this community. Not your keys, not your coins, take physical custody. Caitlin Long's a perfect example. She talks about it all the time, about her experience of losing a few Bitcoin on Mount Gox, and how, so it was like people like that are the ones that a whole new generation of those types of people were just born this past year.
Yep.
And in future bull runs, they're going to be the ones that educate. And I would like to think that people don't have to go through pain or know somebody who went through pain for that to educate themselves. And they've got to find the right role models in the space. And a lot of the times people are looking for somebody that they can harmonize with from a personality standpoint that they trust, that represents their core being, and they're aligning it with people that they're looking at in the community that align with that. And so they're getting that guidance. That's really kind of the only way that I think a person can kind of avoid or basically learn those lessons without feeling the pain is they've got the right people that they're following.
Agreed. Anything to add, Andy?
No, I mean, not much. Pain is the best teacher. I do wish we could somehow gather statistics on, in each cycle, how many people learned about and got their coins into cold storage, without losing any. I suppose there's some percentage. I wish I knew what the percentage was. My guess is that most people, as Preston suggests, learn the hard way. And that's just the way of the world. I learned about the pain of leverage and the risk of leverage the hard way as well. And I wish I'd been smart enough to dodge that bullet earlier in my investment career, but I wasn't. So I don't know why I assume anyone else will be. Nevertheless, we try to educate people and hope that we pick off a few of them and save them some pain.
Agreed. That's definitely one of our core missions here at Swan. That's take your Bitcoin off Swan. Okay, we make it free and easy. You can even automate it, but hold your own keys, please.
I saw Corey was in an argument with somebody, and they brought this up. I don't remember who it was or what the exchange was. I just remember somebody saying, "Well, you have an exchange, Corey. Why don't you?" And Corey just fired back, "I am telling you right now, take your Bitcoin on, get them off of this."
We don't want to hold your Bitcoin for you. You should hold it. You should hold it for yourself. Let's talk for a second about Japan. It's been in the news this week. Kind of shocked the investment world when it loosened its bond yield cap from a 1/4 point to a 1/2 point. And now, less than a week later, they're announcing an unscheduled bond buying program for their shorter term bonds. So what do you think? Let's start with Press on this one. What do you think made the BOJ raise its yield curve control cap like now? What happened?
I think when you look at the rest of their duration of their curve, I mean, it was selling off. It's going and it's selling off. It has higher yields. And then when you look at their 10-year where they had the yield curve control implemented, it was completely out of whack with the rest of their curve. And anybody who understands how banks work, you can't have inverted yield curves for too long until things really start getting dicey for the way that they're managing the risk on their balance sheets. So I think James did a great job. I recently had an interview with James Lavish, and he kind of quantified Japan as kind of the weakest chain the weakest link in the chain for global interest rates. So when you're thinking about global interest rates and you're thinking about how the swaps between various currencies work, the lowest yield relative to the inflation rate of that local currency is going to be where everybody tries to denominate their debts. And so when we look at Japan, the situation here is demonstrating the fact that they had to adjust the yield curve control up to 50 bips on the 10-year, and it used to be at 25 bips, tells us as a global economy that the cheap money is going away, that we're in a new paradigm. Now, whether it stays there or not, or whether they're able to defend that 50 basis point yield that they're at right now, that's yet to be determined. But in general, I think the theme for people as they're looking at this is the global cheap negative nominal interest rate environment that the world had become accustomed to over decades. I think it's over, and I think that the trend is definitely moving in a different direction over the coming 5 to 10 years.
So Andy, I mean, is this a big deal? Have you, like, what are some of the impacts on bond yields maybe that we would see in the US and Europe and risk assets from this move?
Yeah, I mean, I think I agree with everything Preston said. You know, one thing I would add maybe as to why now with Japan. I mean, the yen has gotten absolutely murdered this year.
Yes.
And Japan does have to import certain things. They export a lot of, value added and manufactured goods, but they don't have a lot of energy. And with energy in short supply globally, you have to have currency that can buy barrels of oil and natural gas, for that matter. They're a big LNG importer. They just don't have the energy resources or other, physical natural resources for that matter. So I think if you're running things in Japan, you're realizing that there are major strategic energy and other materials-based needs that you face as a country. And so you can't just let the currency go completely. I mean, you may ultimately be forced to essentially let it go, but at least you're going to keep fighting the good fight while you still can. And so I guess part of me would argue that it's actually a surprise that it sort of took them this long to defend their currency, to the extent that they finally have done here toward year end. But yeah, the Fed led and raised rates, and that really put the squeeze on all foreign central banks, including and especially Japan's.
Well, and the other thing that you get with the currency going down the way that it was going down is you actually incentivize the rest of the world to start buying products and services from your country. So, it's a little bit of, for the people in Japan, it's a little bit like if you ask a fish what water feels like, they're not really going to be able to tell you because they're just in it. And I think for people in their local currency, it can be getting debased very heavily. They don't necessarily really kind of realize it because they're maybe not buying a bunch of things from other parts of the world. But for the large country, or for the large companies that are doing international business, what they're finding is that their revenues are going up despite the loss in buying power that they have on the international stage. So I think that's probably, to Andy's point, why maybe they've allowed it to run in a debasement kind of way relative to other fiat currencies, why they've let it run so long. But it's getting to the point where it's getting a little messy on the global stage because their rates are just so incredibly low relative to everywhere else.
All right, let's move over to housing. So one of the things we've seen this quarter is housing start to roll over. And we just saw pending home sales tumbled 4% month over month. Case-Shiller Home Price Index came out Tuesday, showed another month, 4 months in a row now of declines. So do you guys see these trends continuing? Is this sort of harbinger for a technical or definitional recession or deeper recession in reality for next year? So yeah, let's hear the comments on your thoughts on housing in particular, and then let's roll that into prospects for a broader recession next year. Andy, we'll kick this one to you.
Sure. So I had lunch yesterday with my friend Rich Katz, who's a great local LA Bitcoiner, and he's a big real estate investor. And I'm in his camp, which is more pain ahead. Real estate kind of lags. I mean, it takes a while for higher interest rates and higher mortgage rates to work their way through the system. If you don't have to sell your house, you just wait as long as you can, so you don't take that markdown, take that loss, especially since in a lot of cases, leaving your current house and moving to a new one means you got to put in place a new mortgage that may have a much, much higher rate than the one you've got right now. So, yeah, I don't know if I want to say, roughly speaking, prices are down, I don't know, maybe 10% or something so far. I think that continues. I don't think we're going to get something massive like we did in the housing crisis and the global financial crisis in 2008 and 2009. Don't quote me. I want to say housing went down like 30%. So I don't really expect that kind of an outcome, but somewhere in between, somewhere farther than we've gone so far, but not as bad probably as the global financial crisis. That's kind of my take. I'll pass it to Preston.
I think it has to do with how long the rates stay where they're at, which comes down to how long is inflation going to be continuing to pump out the prints that we've been getting. Because if you keep letting this inflation or the inflation and the interest rates run this hot relative to where they were, you're getting deep illiquidity in the housing market and any type of real estate market. Definitely over in the EU. They've just have the spreads there are so negative and just so disgustingly bad for somebody who's trying to offload something that doesn't have any type of liquidity to it, which is real estate. When you're looking at a typical business cycle, what you have first is housing is the thing that starts kind of manifesting itself. Then you get into the purchase orders for businesses. They start to see a slowdown in that. Next, you would see profits of the business start to decline. And then lastly, I think you would start to see unemployment as kind of like the pecking order of how this plays out. When we look at the unemployment numbers right now, they're the best we've had in decades, which is typically characteristic of the top. We've already seen equities sell off for an entire year at this point. And we're still having unemployment, the best unemployment numbers that we've seen. Now, in the last 20 years, when I look at those metrics and like how they line up, typically when you're getting your best unemployment is when you are hitting the peak in the equity markets. So since we've had an equity sell-off here already, it's kind of interesting when we look at what's still to come. And I think maybe the reason you saw that precede it by so much, the equity sell-off relative to the unemployment numbers, is because we had such a reversal in negative interest rate spread between inflation and what you're getting on, call it the 10-year treasury. It happened so abruptly and it's such a magnitude that I think the equity markets and any type of equity-based valuation just immediately saw there's something drastically wrong. These prices are wrong, and they had to correct themselves. So that would be my argument for why that happened. So do I think a long introduction to the question, but I definitely think that you are in for more pain coming in the coming year, at least for the first half of it. They're going to have to add more monetary units into the system at some point when they really start to break things. I kind of suspect that that's happening here in the coming 2 quarters, that they're going to really break something bad the first half of the new year. And if they add a bunch of monetary units into the system, that has to flow into I would think that it's going to have to flow into, first of all the areas where you had impairment, and it really depends on where they're funneling all that liquidity, whether they're doing something similar to like what we saw in 2020 with COVID, where it was going directly into the pockets of citizens via checks, or whether they're doing it with QE. My opinion is that they're going to be doing a mix of both, and then what pops out of that, it really depends on how much magnitude they do. So I think there's more pain in store for the markets. I think that when you look at the markets relative to Bitcoin, I think Bitcoin's going to outperform from this point forward. It's going to outperform the S&P 500, the NASDAQ, not by a lot, but maybe a little bit. And so like if you were going to denominate the S&P 500 or denominate the NASDAQ in Bitcoin instead of dollars, I think that that's a chart that you would see going down if the S&P 500 or the NASDAQ was in the numerator.
So you think it's unemployment will be one of the main drivers of a Fed pivot? Like once we see that really skyrocketing, that or some
I think
somewhat catastrophic break in the financial system in general.
Yeah, I think they're already seeing signs that this is going to get nasty, the central bankers. But I think they're also kind of in a position where they don't want to step back in too soon because it's so out of whack. The inflation numbers are so high that if they step in too soon and they're not able to reduce it, we get into a situation where real estate numbers are going to get disgustingly bad. To Andy's point where he was saying, I don't think that it's going to get, if they allow inflation to continue to run hot and 7-8% kind of numbers, I think it's going to get really nasty if they can't get it under control. So the thing that I'm struggling with, I'm curious to hear Andy's point of view on this. The thing that I'm struggling with is just the disparity between the US and the EU. So when I'm looking at the U.S. markets, it seems to me like we're going to go through a pretty strong disinflation period here in the first half of the coming year. But when I look at Europe, we're not seeing that, and we're not seeing that because the energy situation is so bad, and I think their policies have been so bad that they're still in double-digit inflation. The numbers are still going up. It doesn't look like they're getting anything under control. They're extremely late. The ECB is extremely late in tightening, unlike the Fed. And so, is the U.S. disinflation that's likely coming? I'm pretty sure in the coming 6 months going to assist them in Europe to try to get their prices under control, or is their supply chains so broke and are their policies so broke that they're not going to get any of it under control? Yeah. Despite the impairment that you're going to naturally see here in the US. I don't know how to answer that question. It's the thing that I'm kind of chewing on. I don't really know how to, because if you can't get it under control on a global stage, and Europe is like getting into chaos, and they're going to have to print to subsidize all of that. Like you get yourself in a snowball situation that unravels, that none of this gets under control, right? And that's the thing that I'm toying with, that I don't have an answer for. I'm curious what people think. Put it in the chat. I'd love to read what your thoughts are. And Andy, what you think?
Let's hear what you think.
Yeah. I'll take my best guess at it, and of course, it is only a guess. I do think that euro dollar FX is going to be crucial here, which will in large part spring out of, as you said, Preston, Fed policy. If you get continued reductions in the CPI and the PCE coming through, we've got a couple negative prints, negative in the good sense, right? Lower inflation numbers. If that continues and the Fed gets a chance to ease its foot off the gas, which it has already in terms of the rate of increases, but if we can stop the rate increases, you may see a local top in the dollar here for a while. Dollar could continue to lose ground as it has a little bit recently against the euro. That would be hugely helpful on a relative basis for inflation in Europe. Now, is that going to solve Europe's inflation problem? No. As Preston said, energy is crucial there. Where else could you get relief? Maybe if some good news comes out of Ukraine. I'm not expecting that, but when I think about how could this go better for the inflation situation in Europe, that's another possibility. But I definitely have to concede that the inflation picture and the economic picture in Europe looks tough, and certainly looks significantly tougher than it does here in Fortress America.
With our exorbitant privilege.
That's right. Our currency, but your problem, right?
Exactly.
As the saying goes.
Everyone who's watching on YouTube right now, just a reminder that we will be moving to Twitter Spaces after the show. Invite you to come and join us there, the @Swan Bitcoin handle. You'll be able to come up on stage and ask these guys some questions. So I do encourage you to hop over there with us at the end of the YouTube segment here. Let's talk about oil. Black gold. In Q4, we saw the strategic reserve get drained to its lowest level since 1983, down 33% since the Russia invasion. This is in part why people believe that crude has fallen over 5% this quarter. Now we have reports that China's going to be opening up from its COVID lockdown policies. So, Preston, we'll start with you on this one. Where do you see the price of oil going from here?
First, Andy, do you buy this China's reopening thing?
I think, partly yes. I think that I think the data, it's like, who knows? I mean, you take everything with a giant grain of salt. I do think they have to get this engine started again. I think if you stall out, if the aircraft stalls out for long enough, you're not going to be able to pull out of the tailspin. But I don't have high confidence in any specific data.
I'm not buying it. And I don't know why. It's just kind of gut. Like, it just seems like something is really systemically broken there politically. And I can't wrap my head around it. I've listened to a lot of different interviews and trying to find the experts in China to kind of get their point of view. But it just seems like the decisions they're making over there are so strange. Like the lockdowns, like the Apple facility, like all of it is just so strange to me. And it seems like they're doing something that doesn't make sense to a Westerner. And so them, like, I read these reports on the Wall Street Journal, like, oh, China's going to reopen and it's going to cause a supply, or it's going to suck the supply out of the oil market, which is going to cause the prices to rip, which it would if they did reopen. But I don't know. I don't really know how to kind of handle it. I think that's the key point here, because let's say China continues to be closed down like it is, or like it's been for the last year. The demand destruction that potentially is going to happen here in the first half of the year is hopefully going to allow oil prices to remain pretty low and affordable for people. But if for in fact it is opening up and all of that demand comes back online, like, I don't know, I don't know what they're going to do with oil prices, because it's been a bit of a game of chicken here in the U.S. with the SPR, the Strategic Petroleum Reserve, and how it was used for the year, and how much it's been drawn down, and how much there really is to, in these caverns. For people that aren't familiar, a lot of this oil is stored in caverns. And so, like, knowing how much is actually there is kind of a little, it's a little tricky. So if I was going to bet, and then you throw in the whole Europe piece as well, right? Which is just a mess. It's really hard to kind of make a forecast on something like this. I'm very hopeful that the prices are going to stay down and that China does not come back online. And I guess they're able to kind of manage this a little bit, but I don't put a lot of probabilities on any of the whether it's going higher or staying flat.
I think it's interesting to look at the major industrial commodities and their prices recently. Oil is one. Industrial metals like copper and iron and steel are another. I do see a divergence. I mean, I look at hopefully these data are right from my Bloomberg sheet here, but 1 month versus 1 month ago, and we got the China quote unquote news, I think in the last couple of weeks, certainly in the last month. Crude hasn't moved, WTI hasn't moved, Brent hasn't moved. The metals are up. I'm showing copper's up 6%, iron's up almost 10%, steel's up 12%. So it's a little of a divergence between oil and the industrial metals. So maybe that's an indicator that market participants are confused or questioning the narrative, just like you are, Preston.
I just know from the negative spread and interest rates, like they need to keep these prices down. They cannot let these prices run up again, and we can't afford to go back to 8 or 9% inflation. Or I think it's just going to be destruction in equity, anything that's equity based here in the U.S.
Yeah, I mean, positioning myself, clients, etc. Still pretty conservative, still pretty defensive. I mean, I look at the risk return on equities from here, given facts and circumstances, and it kind of looks like assets are priced for the quote unquote soft landing, right? It's like you look at the probability distribution and you look at the price on equities and you say, oh, the market thinks that it's more likely than not that we're not going to have a recession. And I don't see that as particularly likely. Recession's definitely my base case. And in that scenario, almost no asset looks cheap right now.
Yeah, I'm with you 100%. To say this is going to be a soft landing is very laughable for me. Like, there's no way. This is going to be a hard landing. Definitely my base case.
So we may be looking at conditions in which this show was born, March 2020. So we see some kind of crazy short term, crash. Is that where is that going to mark the bottom? Are we going to drift down along with these Fed ratchets and kind of hit, like, it's not really, I wouldn't call it a soft landing. I'd still call it a crash landing, but we're creating like a super long trench as the plane sort of glides along the ground. Or is it going to be like, side of a mountain? What are we looking at?
Typically you get contagion when the central banks throw in the towel and they say, all right, we have got a reset underway here. Enough zombies have been killed, and now let's go ahead and usher in the next reflation period. And typically what triggers that is something that is really breaks the markets in a credit kind of way. So I expect that. Now, it might be this long drawn out. It's really ugly. And here's what would cause that, Brady, is if they still have these inflationary prints in excess of 5% and things are selling off like crazy through all of that, and they're still showing signs that they don't have it under control, it's going to be that latter scenario that you described, where the plane's dragging through and then you have a big giant capitulation. It really comes down to the confidence that they have that they finally slayed the inflation beast enough. That's what it's going to come down to.
Yeah.
Maybe I'll comment a little bit on rather than equities, prices and what that would look like. Maybe I'll comment on Bitcoin price. The one thing, because everybody wants to know, have we bottomed? Is the bottom behind us? Lots of signs of a bottom. Several major blowups. The latest of which, with FTX, I mean, it didn't move BTC down by that much, right? It's a good sign, frankly, that Bitcoin price has been as resilient in the face of that debacle as it has. I will say the one thing we've kind of been missing for a bottom is real volume, high volume. In the liquidation that you were referencing in March 2020, there was some volume on that one. There were there's high volumes on prior bottoms in Bitcoin price. So that might be the one sort of missing ingredient for being certain that we've seen a bottom. Now, having said that, I look at the chart and the time to the halving, and I look at the last cycle, and we're kind of at the point when we bottomed in terms of time until the upcoming halving, when we bottomed last cycle. And I always like to ask people, when they're talking about further downside risk in Bitcoin price, I like to ask them, remember back in early 2019, we had dumped, price was in the 3K range or a little bit higher, and we hung out there for a few months. And then we got this green candle, this like 20 or 25% green candle in price in April of 2019. So question Preston and question Brady, do you remember what the catalyst was for that green candle that took us off the bottom?
Probably all the people shorting it.
Yeah, exactly. It's a trick question. The answer is there was no catalyst. Nothing happened that day, right? Just the price went up, and you never really saw, you never saw 3K again. Yeah, for like a few hours in March 2020, you saw 3,800. You saw just under 4K, but it didn't really last. Oh, and by the way, if you're hoping and praying for that wick downward, that probably means you're holding fiat on an exchange, which I don't especially recommend right now, given the facts and circumstances going on with all the exchanges. So, yeah, I think that it's impossible to call bottoms. I'm in Preston's camp, which is, the asymmetry looks severely skewed to the upside in terms of the opportunity on Bitcoin price. So I'm pretty bullish. I'm not going to call a bottom, but the risk return looks quite favorable.
It's extremely difficult to outperform cash when central bankers are acting the way that they're acting, which is tightening credit and sucking monetary units out of the system. It's really hard to outperform cash. So let me give you an example, and this is going back to Andy's point of how's Bitcoin going to perform in the next 6 months or year. When let's say you're a business, let's say you're sweeping all your free cash flows into Bitcoin, right? And you're going through this economic storm, and normally you're profitable. Maybe you have 10% margins after tax, and vendors that you receive inbound payments from start going bust. And they call you and they say, sorry, I can't pay you. I don't have the money to pay you. I'm going bankrupt, right? Now, all of a sudden, and let's say that one vendor is 10% of the revenue coming through the door. Now you're in a situation where you're at a break even, and now it starts to accelerate. It starts to snowball. So now that business that is normally profitable has to start making decisions. Do we sell our treasury that we're sweeping completely? And I'm using this as an example just to show people the stress points and how it plays out. But for the example, we're assuming this company is sweeping all their free cash flows into Bitcoin. This company now has to make a decision. Do we fire employees and reduce our future revenues, or do we go into our retained earnings and take some of those and start paying our employees so that we don't have to fire anybody? And hopefully in the next 3 months, 6 months, year, we get back into the green again because central bankers start reflating the economy and there's more monetary units and people aren't going bankrupt. This is the calculus of how more Bitcoin could sell, even though these prices are screaming low relative to a lot of these on-chain metrics and everything that people like to say. It's business. Most businesses have counterparties. They have responsibilities. Those bills are denominated in fiat currencies, okay? They're not denominated in Bitcoin, even though we would love every employee to want to be paid in Bitcoin. They don't want to be paid in Bitcoin because their electrical bills and their gas bills and all these other things are still denominated in dollars, euros, whatever. So that's where the selling comes from. The selling comes from people that have to sell it because of their counterparties. And I would just say that's why you're going to continue to have pressure on Bitcoin as the world, from a global standpoint, is clawing more and more fiat units out of the system. It's really hard to outperform those fiat units in the short term. In the long term, we all know where this is going. because they're going to have to add trillions more, and they're just going to shove it into people's pockets. They're going to shove it into the bankers. But hell, they're shoving it into the bankers' pockets right now, whether people know it or not, to the tune of like $300 billion a year because of the deferred assets situation. But anyway.
Well, what is the deferred asset situation? Since there are certainly people out there that won't know what that means.
I wish I could explain it to you. It's too convoluted and confusing. No.
All right, we'll ask Lynn.
In short, the Fed will run a surplus. They take that surplus and they send it to the Treasury. Recently, because they have to incentivize banks to not lend money. Why? Because if these banks lend all of these reserves that they're sitting on, you will see really high inflation. You'll see 15% inflation. You'll see whatever, right? I'd have to go do the math of like what that would equate to if these banks weren't being incentivized by the Federal Reserve to place their deposits at the Fed to collect these higher interest rates that they're raising the interest rates on. So as they did this, and as they have these higher rates that they're paying banks to not lend money, it has put them in a situation where they're not, quote unquote, profitable in sending the Treasury a check. They have a loss, and that loss is to the tune of about $300 billion a year. So like, that's a lot of money. That's nearly like half of the Defense Department's budget. It's that much money, and it's all interest, and it's going to all these too big to fail banks. It's going straight onto their balance sheet. And then guess what they're doing with that? They're going out and buying more treasuries so that they can collect more interest and put them on deposit at the Fed so that they can go. So it's insane. It's absolutely insane.
This is how the world is run, Andy.
Yeah, and they're not kicking it back to their depositors, right? To their customers. The interest rate on your bank account is still pathetic, severely lagging, the move in federal funds rate and treasuries and interest on reserves and all that. I'm looking at Fred, the Federal Reserve, the database basically showing interest on reserve balances, the rate of 4.4%. Pretty good, right? Pretty good, decent rate to park your money there. And Preston's spot on.
For what risk, right?
Exactly. For no risk. Preston's spot on that if that rate wasn't there and they actually lent out the money, you'd get that huge credit multiplier on the base money, and you would get ridiculous inflation, and that would be disastrous. So yeah, they gotta keep paying the bankers to prevent that inflation.
Here's the crazy part, right? So you have the SLR. So the SLR is the leverage ratio of like how much the banks have to keep on their books, right? I don't know what the rate is, but we'll just use simple numbers. Let's say it's 10%, right? So they have to keep reserves of 10%. So if they're trying to incentivize banks to not lend money, you could just raise it up to whatever most of them are sitting on. Let's say they're all sitting on 15%, right? And the Fed doesn't want the extra 5% to be lent out. So today, what they're doing is they're paying that huge interest rate that Andy just told you. I'm saying huge, but relative to inflation, it's not that much. But compared to the rest of the free and open market, I'm using air quotes here, that 5% adds up to an enormous amount of money. They don't have to pay that if they just raise the SLR to 15%. But they're never going to do that because of how strong the lobbying is of these banks, because they want the SLR to stay low so that they can continue to get the free gravy train and just put it on their balance sheet. Anyway.
And I mean, to kind of continue down that line of the, just the malincentives in the system, we passed a $1.7 trillion spending bill last week. U.S. national debt's at $31 trillion, mind-boggling. Right, this profligate spending, but right now, I mean, with CPI inflation still, high, is there any like faith or hope left that we might get politicians in Washington that would be fiscally conservative or champion these like responsible sort of banking policies that Preston's talking about? Is there any hope? Like, is that going to happen at all? Or is there only like one path to sort of restoring economic order on a global scale?
Yeah, I
Which,
think
of
it's
course, would be Bitcoin.
near zero probability of fiscal rectitude. And two reasons for that. I mean, one is we're just already too far down the path, right? There's already too much debt. You're past the point of no return. You're past the event horizon. Pick your favorite analogy there. It's too late. And then, yeah, the second is the incentives. I mean, it's become pretty clear that politicians elected on 2, 4, and 6-year cycles get reelected if they deliver the goodies, especially if they deliver more goodies than will fit into their budget. So they borrow and spend. I mean, you never say never, but it's like, 1% probability that it gets fixed in the next couple of decades.
It's just a simple incentive thing for me.
Right.
Like, what's the incentive for them to not try to vote money into their local districts at this point? And what's their incentive when the broader population, regardless of political affiliation, is all for it? Is saying, yeah, send me another check. I know inflation's high. That's why I need the other check. That's the logic. But from if you lined up 100 people, like 90 of them would be saying that tune. 10 of them would be saying, no, that's why your prices are higher. So I think when you just look at the basic incentives and you look at how, they're looking at these without term limits, right? Like, that's, if I was going to define a critical variable of like how maybe they could be incentivized, but the mathematics are jacked. Like, that's separate. The math doesn't work based on how indebted we are and what that looks like. And then the other part of that equation is like their incentive and that there's no term limits are really the two critical reasons why that you're not going to see it happen.
And everybody knows that they have a printing press, a monetary printing press, right? And that's what makes these kinds of profligate spending bills and $600 billion defense budgets, et cetera, possible and fundable. So if we have a Bitcoin standard, do you think that would change fundamentally the nature of government to realign those incentives? I tweeted this the other day. I think that a lot of the bad outcomes and problems with society that are blamed on capitalism are misblamed on capitalism. It's actually a result of a fiat monetary system, and we can actually see maybe amongst other things a more functional government. What do you think about that?
Yeah,
one of the things that I'm sorry, go ahead, Andy.
No, I was going to say, spot on, right? It's sort of kind of a capitalist market-based system, except for the most important good in the entire economy, right? The one good that's half of every transaction, which is money. So yeah, it's crony capitalism. It's not true capitalism. That's just the way it is. And yeah, it's almost nobody understands this fact. And I don't, we talk about it, we try to educate people about it, and yet it's an uphill battle. So I don't see a path to full capitalism or truly free markets, before the resolution, quote unquote, of the debt problem. Yep. So I hope I'm wrong. I hope we figure this out, but I am not holding my breath.
Yeah.
When you see the general population endorsing caps on the prices of commodities, and it's a majority of them that have this opinion, know you're screwed. Screwed, because the way you get consumption under control is you got to let the prices run hot. You can't step into that market and cap it. And because that's the same thing as printing money and handing it out. You're incentivizing excess consumption when you do that. Now, let's pull the thread on, so that it's really understandable when it's a commodity like oil or gas or any of that kind of stuff. It's just really obvious. And you're already seeing people endorsing it on the obvious stuff. Now let's look at the non-obvious stuff like treasuries. When we control the yield on a treasury,
Yep.
We are doing that exact same thing, which means you're controlling the price of money itself. And when you're controlling the price of money itself, you're then putting you're putting a cap on prices for everything, literally everything. And so when you look at all these net consuming countries, they're all doing that. The net producing countries are saying, we're sick of it. We're sick of it. We're not taking your paper promises anymore.
Mm-hmm.
All about, man, the whole thing.
Monetary socialism. All right. Let's wrap up this portion of the show. Gentlemen, I'll see you over on Spaces in just a moment. Those of you listening in Spaces, get some questions ready for these two rock stars. And if you're watching on YouTube, hop over to @SwanBitcoin on your Twitter app, and or just look up at the top of your Twitter app if you're already following Swan or Preston or Andy or me. You'll see us because we're all up on stage. All right. See you guys over there. And thank you for joining us for this segment of the show. Do hope to see you over on Twitter Spaces. Signing off YouTube now. Thanks.